Good day, this is Jevon Para, mortgage lender, paraloans.com, and I just want to give you a rent versus own analysis. It's really important to know the real numbers that you're comparing with instead of just price versus price when you're thinking about rent versus buy. There's so many benefits. So let's take a rent. So if you're renting right now, the first question is, hey, if I'm at a $1,900 rent or $1,500 rent, if you were going to buy, would you stay where you're at for 5 years? This is a 5-year analysis, is why I use that number. And if the answer is no, it's like the next question is, well, how much would you pay for rent with the place that you would rent for if you didn't buy? So this particular couple was at $1,500. They would pay $1,900. They thought at a minimum on where they were going to rent if they didn't buy. And then I asked them, well, how much rent would increase per year? And they said, well, it's been increasing about $100 per year, average. So over 5 years, that's $300 average. And so what we're using as just a comparison tool is their $1,900 rent plus the 5-year normal increases. And so that would be an extra $300 on average that we're going to compare. So we use $2,200. Now, this particular couple was buying at $750. Maybe your numbers are different. I'm happy to run those for you. But they're going to put 10% down. And with 10% down on a $750 purchase, their payment was at $4,500. So if you look, that's a lot. That's a big difference, $2,200 versus $4,500. But the thing to consider are a couple things. One, they have tax benefits. In this case, at a 22% tax bracket, they're going to get an extra $610 per month, or over $7,000 a year in tax benefits, or money back in their pocket because they can write off their mortgage insurance that they would have spent on taxes. Every month also, they're going to have an extra $868 plus that is going to pay down their loan, and every time they pay down the loan with their normal mortgage payment, they're going to increase their equity. So here's another way to look at it. Let's go down here. If they were to keep on renting for another 5 years at these numbers, at the end of 5 years, they would have spent $132,000 in rent with no long-term financial gain, just a place to stay. And that goes to their landlord. Or if they bought now, they would have over $35,000 cash in their pocket from money that they didn't spend on taxes. And remember, they put 10% down, or $75,000 down on this place. At the end of 5 years, with that $75,000 down, with 4% appreciation, and appreciation in our area, Southern California, has been well over 7% over the last 50 years average. So I'm using 4% appreciation. Plus, every time they make the mortgage payment, again, they were buying down or paying down the loan, so that increased the equity. After 5 years, there's $75,000 turned into over $296,000 in equity. And if that number isn't incredible to you, I just think it's incredible how fast that grows. So if you have any questions about this, please let me know. There's a lot of other things. There's the cost of waiting. If they wait, the payment goes up because rates and the prices are going up. The same house, when the rate and the price goes up from $4,500 a month to $4,850 almost a month, it's the same house just because they waited. And this is what's happening right now. Please, Jevon Para with Fairway Mortgage, and I'd love to be able to help run these numbers for you too, if that's helpful. Have a great day.